Hello and welcome to XM's educational series Ask the Expert. In this video we're going to be diving into the relatively new phenomenon of quantitative tightening and specifically its implications. Quantitative tightening, or QT in its abbreviated format, is the process by which a central bank reduces its balance sheet, and in doing so it decreases the supply of money in the financial system. Central banks can shrink their balance sheets in two ways: by letting maturing bonds from their holdings to roll off instead of reinvesting in them, or by directly selling the bonds through open market operations. To put it simply, quantitative tightening removes liquidity from the economy and is the opposite of quantitative easing, which pumps more liquidity into the economy. So why are central banks like the Fed engaging in QT? Well, just as central banks raise or cut interest rates to meet their inflation targets, they also adjust the size of their balance sheets as one of their many policy tools. At times of crisis, most recently the pandemic, the response by most central banks is to buy government bonds to boost money supply. We should point out here that the balance sheets first soared after the 2008 financial crisis, and when the pandemic came along, central banks had to intervene again to stave off economic collapse. However, now that the crisis is over, the time has come for central banks to normalize their balance sheets. So how does this work? Well, every time a bond matures or is sold and the proceeds are not reinvested, there is less money flowing to the economy and monetary policy effectively becomes tighter. But the real question is, how does this affect the markets? QT doesn't have as much of a direct impact as rising interest rates do. It tends to work in the background, slowly draining liquidity out of the financial system. Its effects may even be unfelt during times of market stability. However, they do exert upward pressure on bond yields, as fewer government bonds are snapped up by the central bank. Thus, more of it has to be absorbed by financial institutions. What's more, tighter monetary conditions eventually start to hurt equity markets as liquidity dries up. Now, as these are the intended effects of QT, it's not a big worry for policymakers. That is, until they become exacerbated by additional forces. For example, if yields are being driven higher by simultaneous hikes in interest rates, the economy and in particular stock markets will begin to feel the pain of tighter financial conditions, potentially leading to a market panic. I hope this video helped you understand more about QT, and if you enjoyed watching it, please click on the like button. You can also email us at asktheexpert@xm.com if you have any questions you would like us to answer.